A Monte Carlo analysis is not a financial plan. I see too many people who think they have a financial plan in place because an online calculator or financial planner ran a Monte Carlo analysis for them. Now, while that might be a good starting point, there's a whole lot that Monte Carlo analysis misses. So in today's video, I'm going to walk through the limitations of a Monte Carlo analysis and, more importantly, talk through what a real financial plan should do for you. Hey everybody, I'm James Canal with Root Financial Partners, and I'm here to teach you what you need to know to create a secure retirement. I get to speak with a lot of people in my role as a financial planner. Now, one of the first things I like to ask people is I'll ask them, have you ever worked with a financial planner before? For people that say yes, I'll ask them to describe their experience, and a lot of times they just describe the experience of getting the Monte Carlo analysis run. Now, to me, that's a component of a financial plan, but it's a very small component, and it misses the bigger picture. By itself, it's certainly not a financial plan. A financial plan tells you what to do. It tells you what actions you need to take to be on track for what you're doing. Monte Carlo analysis gives you some vague sense of your probability of success. Now, for those of you watching who have never heard of a Monte Carlo analysis before, or maybe have heard of it but really don't know what it does, here's what it is. When you do a financial plan or when you implement a projection, you need to make an assumption about what rate of return will your portfolio grow by. So let's assume we run a projection where we say your portfolio is going to grow by 6% per year throughout retirement. Well, that analysis is going to assume you get 6% per year every single year, which on average is maybe accurate, that you'll get 6% over the course of time, but you're certainly not going to get it every single year. And not just that, but if you take two people, let's say you have person one and person two, both of them retire an average 6% per year throughout retirement. Person one, though, they retire and have 3, 4, 5, 6, 7 great years in their first few years of retirement with above average returns. Person two, though, has the opposite experience. Goes through a horrible bear market the first few years of retirement, the portfolio losing money each for the first several years. Well, even if over the course of their 20, 30-year retirement, they both end up averaging 6%, person one's gonna have a lot better experience over time because of those good years up front, where person two is gonna have a much worse experience because of the bad years up front. And those were compounded by the fact that they were drawing money from their portfolio. What a Monte Carlo analysis does is it wants to explore, it simulates 10,000 different returns. It says, okay, here's your financial projection if you get 6%, but what if we run a Monte Carlo analysis? What if we literally take 10,000 different simulations of good markets, bad markets, everything in between to start to see what's the range of potential outcomes? What's the best case scenario versus the worst case scenario? And when you do it, what you essentially want to get to is a probability of success. So when you hear people say your probability of success is 80% or your probability of success is 90%, what it means is of those 10,000 different scenarios that were run, 80% of the time or 90% of the time, you were able to meet your goals, but the other 10 to 20% or so, you fell short because of different returns in the market, because of certain below average returns in the market and the timing of when you received them. So that's what a Monte Carlo analysis is. So there's some benefit to that, and that's certainly a component of a good financial plan. The problem is I see far too many advisors who use that as the financial plan, and their feedback to a client might be this. It might be, if your Monte Carlo analysis projections come in at 85% or higher, that's good news. If they come in between 70 and 85%, we might need to monitor some things along the way, and you know what, if it's below 70%, you've got some real things you need to work on. And they may fluctuate those numbers or change those numbers, but that's the gist of it. And to me, that misses the point. It doesn't tell someone what to do. It doesn't tell them how much they need to save. It doesn't tell them what steps they need to take to be on track. It just gives you this vague sense of what are you doing and are you going to make it or not. So the challenge is, if I come to you and I say you have a 90% chance of success throughout retirement, does that make you feel good? Or does that make you think, well, what about those other 10% of chances? What happens there? I don't want to get on an airplane with only a 90% chance of success. Why would I want to go into retirement with a 90% chance of success? It misses a lot of the key information that can truly make a financial plan effective. It's kind of like this. If you have a Monte Carlo analysis and that's all you have, it's kind of like going on a hike with a tour guide. And at the beginning of the hike, the tour guide stops and says, okay, well, if you go down that path, you have a 90% chance of getting to where you want to go. And you look at that and say, okay, so we're probably going to make it, but what if you don't? Well, a true financial plan would say this. It would say, are there better paths to take along the way? Are there certain shortcuts you can take to get to your goal faster? Are there certain areas where you shouldn't just be pushing and should stop and enjoy the view for a little bit? A financial plan is going to tell you, here's the action steps you should take. Here's what you can do to maximize your chances of success, not just give you a vague, generic probability of success that's not actually going to play out exactly as you think it will. So a financial plan, it tells you what to do. It gives you actions. Monte Carlo analysis gives you a probability of success, but it should not be a standalone financial plan by itself. So let's look at high level, what are the benefits of this analysis and how can it help you in your retirement planning versus what are the downsides and what should you be doing instead? So to start, the first downside is this. Just because you had a hypothetical Monte Carlo analysis that said you have a 100% chance of success, it doesn't automatically mean that you're optimizing everything that you can. Let's look at an example. Let's assume that you have some financial planning software and you want to say, what's my Monte Carlo score? Well, let's assume that you want to live on $60,000 per year in retirement. What you're going to do is you're going to put in your different income sources, your different investments, all those different things. And let's assume that between Social Security and a pension, you have $70,000 per year coming in. Well, right off the bat, regardless of how your investments are allocated, the software is going to say you have a 100% probability of success. Your income is $70,000, your expenses are $60,000, so even if your assets are managed horribly, you're going to be on track, and the software is going to say you have a 100% probability of success. Is that meaningful for you? Well, in some ways it's good to know that you're going to make it, but it doesn't tell you, here's how you should allocate your investments. Here's a tax strategy you should be implementing. Here's what you should be doing in order to maximize the estate you want to leave to your family. There's no action steps to be taken. It just gives you this sense, maybe even this false confidence of you're doing everything right, when in reality it's because of the income sources you have, not because of what you're doing on the balance sheet and what you're doing with your investments. The second thing that the Monte Carlo analysis misses is it doesn't give you a sense of what do you need to do to get on the path from where you are today to where you want to be in the future. It doesn't talk to you about what's the cost of your retirement, what's the impact of inflation over time, where different income sources are going to come from, how should you allocate your investment portfolio to fill in those income sources, what tax strategy should you implement. It's not going to do any of those things. Whether your score is 0% or 100%, it's missing the main point of a financial plan should be a written plan that says here are the specific things to do to be on track to accomplish your goals in the way that's most effective for you. So it's not going to do that, which is a downside of a Monte Carlo analysis. The third downside with a Monte Carlo analysis is this. It does not explain or doesn't clearly project the magnitude of potential failure. Let's look at an example. I'm pulling this example from a Michael Kitz's blog post where it actually looked at Monte Carlo analysis and some of the downsides here. And it uses an example where it says, let's assume that you have George and Susan. And George and Susan, they want to spend $6,000 per month. And jointly, they're receiving $5,500 per month in Social Security, which means they're actually only relying upon their portfolio for the remaining $500 per month. Well, if they run a Monte Carlo analysis and they fail, according to that analysis, what that essentially means is they've run out of portfolio assets. They've spent down their portfolio before the end of their lifetime. Well, for them, the magnitude of failure is relatively insignificant. It means their pay or their standard of living goes from $6,000 per month down to $5,500 per month. Now compare that to Jerry and Elaine, which this article says. And by Jerry and Elaine, they also have target spending of $6,000 per month, but they have zero Social Security or pension coming in from other methods or other sources. For them, if they were to run out of money, if they were to run out of portfolio assets before the end of their lives, they would have $0 of income coming in. So even if George and Susan and Jerry and Elaine both have the same probability of success, it doesn't measure the magnitude of failure. For George and Susan, even if they quote unquote fail, they still have solid income coming in to meet most of their needs. For Jerry and Elaine, if they fail, they have nothing coming in to meet their needs. So it doesn't help to understand what actually matters most, which is, do you have enough income coming in to meet your expenses? And the magnitude of failure isn't reflected in any of the analysis. The fourth downside of a Monte Carlo analysis is it just doesn't give you peace of mind. If someone tells you you have a 90% probability of success, all you hear is you have a 10% probability of failure. That's not necessarily what it means. What it does mean is you have a 10% chance of probably needing to make some adjustment along the way. You'll probably need to make a spending adjustment if there's a horrible bear market. You'll probably need to make an adjustment as to how you pull money out of your portfolio. Maybe you need to make an adjustment of pushing a vacation back a couple of years if there's bad timing in the market. That's how it should be perceived, is there's a 10% chance that you'll need to make some adjustment along the way if things aren't going according to plan just perfectly. So Monte Carlo analysis doesn't necessarily do a great job of giving that peace of mind when it's only used as the only tool for financial planning. Now, that being said, there are some benefits to Monte Carlo analysis, and these are what the benefits are as I perceive them. Number one, there's a saying that said, I'd rather be approximately right than precisely wrong. To me, that's the benefit of Monte Carlo analysis. You're going to be approximately right. We can't predict the future. We can't predict the markets. We don't know what's going to unfold. So having a Monte Carlo analysis gives us a general sense of what direction are we headed, if not precision along the way. Number two, a Monte Carlo analysis gives you somewhat of a temperature check. If you have a 10% probability of success after running this, you probably know that you need to go back to the drawing board. Okay, do I need to work longer? Do I need to save more? Do I need to cut spending in retirement? It gives you a general sense of, do we need to do some major things? If you have a 100% probability of success, I look at that to say you're probably significantly overfunded. Where if this is all the money that you're spending, you're probably gonna have a really large portfolio balance left at the end of your lifetime. Do you wanna do more spending? Do you wanna be able to live more enhanced lifestyle along the way versus just leaving a significant pile of money when you're no longer here? So it does give you a temperature check of, are we way off track, either in terms of being underfunded or significantly overfunded? That is one major benefit of a Monte Carlo analysis. And then number three, it does help to illustrate the uncertainty of investing. It's not as easy as projecting a 6% rate of return or a 3% rate of return or a 10% rate of return. Even though all of those could be long-term averages for different types of portfolios, there's no certainty that you're going to get that every single year. In fact, there's a certainty that you're not going to get those every single year. So a Monte Carlo analysis helps to illustrate that the timing of when we receive those different growth rates really has a significant impact on our plan as a whole. So with a Monte Carlo analysis by itself, it is not a financial plan. It can be used to supplement a financial plan, but here's what your financial plan should tell you. It should tell you how much can you confidently spend throughout your retirement? Where will your income come from? How do you protect against risks of healthcare, long-term care, death? How do you save the most amount of money in taxes over the course of your retirement? How should you best allocate your assets to support your retirement goals? How can you live your best life? Really, when you look at a financial plan, what it should be doing is giving you specific things to take, specific actions to take to enhance your quality of life. Monte Carlo analysis can supplement that and support that and put that in context, but it cannot replace that. So at the end of the day, when you're talking to your financial planner or when you're revisiting your online calculator, your goal with financial planning shouldn't be to see how can I get my Monte Carlo analysis score to go from 97% to 98%. At that point, you're just spinning your wheels. It's not the most effective thing to do. The most effective thing to do is to understand, what does a great life look like to you, and what actions can you take along the way to best support that and to move forward in that direction. So while Monte Carlo analysis isn't the most effective way to run a financial plan, check out the video above. That will give you the 5 most important aspects of a financial plan to determine what does make most sense as you plan for your retirement goals. Thanks for watching. This is James Knoll with Root Financial Partners. If you enjoyed this video, please be sure to share it with someone else who you think would benefit from this information. And also, please be sure to like and subscribe for more content just like this. Finally, if you'd like to see how we help clients create a secure retirement, be sure to check out our website at rootfinancialpartners.com.